Before we get started, I like to say a few words about where we are. Today we're broadcasting from Stanford University in the heart of Silicon Valley. Since World War II, Stanford has encouraged its faculty and students to develop new technologies and turn them into great companies. Welcome to Ask a Silicon Valley Lawyer. I'm Louis Lehot, and I help companies get formed, financed, scaled for growth, bought and sold from my offices here in Palo Alto, often in San Francisco. And if you like what you see, please leave a comment below. If you have an idea about what you'd like us to talk about, love to hear it. Today I wanted to talk to you about early stage financing. How do companies get off the ground? How do they find capital to grow? And we're going to focus and dive a little bit deeper into convertible notes versus safes. But before we get there, I wanted to set the stage. So, where do we find money? The first and best way of finding cash is by selling a good or a service, obviously. But if you're at the formation stage, you're probably looking for capital to create a minimum viable product that later on you'll be able to sell. But certainly if you could finance your growth with the sale of a good or a service, that's not going to have any long-term impact on the company's capitalization or your ownership. So obviously the first and the best way to go about things. The second way would be some sort of a government grant. We call this non-dilutive capital. It's very frequently used in Europe and in Asia, where you're able to locate a government agency that has a reason to support the growth of technology in your specific region or your specific vertical, and they're willing to give you a grant of some kind. This is a great way to finance the growth of your capital, of your company. Next is selling equity, and the other is selling debt. Or a piece of paper that obligates you to repay money later. Selling equity, no matter what kind of equity it is, at the startup stage is the worst possible time. Before you've developed a minimum viable product, before you have your first dollar of revenue of a scalable business, is really not the time to ask anybody to put a value on your company. So if you sell equity, generally you're going to get a very, very low price. And it's going to be a price higher than nothing, higher than a peppercorn, and so you won't have a lot of leeway to grant options at a price, stock options at a price lower than the price at which you raise equity, and so it's not a good method of raising capital at the formation stage. The last method of debt is, obviously an obligation to repay money later. It's borrowed money. Usually borrowed money has a maturity date. It usually has an interest rate, and sometimes it can have security such that if you fail to repay it in the time period, including the interest, that the holder of that debt instrument could require you to give them the business. And they could foreclose on the loan. Think of a mortgage on your house. If you don't pay the mortgagor, you get foreclosed on. So convertible notes and safes are really hybrids of equity and debt. A convertible note is it is an instrument. It is borrowed money. It is a security, but typically it converts into an equity security when you've raised a certain amount of capital at some sort of a discount to compensate the lender for the risk that they've taken that in financing you at the earliest possible stage and waiting to get converted into equity. So a convertible note is a great instrument for a startup because it defers putting a price on the equity until later. Now the safe was created by Carolyn and Jonathan Levy in 10 years ago in San Francisco when they were affiliated with an accelerator program that's very prestigious called Y Combinator. So a safe is a simple agreement for future equity. The principal difference between a convertible note and a safe is that a safe does not have a maturity date. It does not have a security interest. It doesn't have a rate of interest. and it converts into the equity often at some sort of a discount, just like a convertible note. But there isn't a specific date, and therefore it's very founder favorable. It's become ubiquitous in the Northern California and really all over the world. Although many investors will prefer a convertible note because they have a time period during which they know that they'll get reimbursed, and they get interest as well as the discount on conversion. So those are the essential differences between the convertible note and the SAFE. The SAFE is more founder favorable. The convertible note is more investor favorable. I wanted to talk about some frequent issues that pop up whether you're using a convertible note or a SAFE as you bring your financing along and as you raise capital over a time period that's getting stretched out longer and longer before you raise your Series A. I'm finding that convertible notes are often having different rates of interest, different maturity dates, different discounts upon conversion, and therefore keeping track of the pro forma impact of the issuance of all of the convertible notes upon conversion into the Series A is more and more complicated, and Series A investors are often very disciplined on the amount of equity that they want in a company post Series A, and therefore founders are really getting hurt by the length of the periods during which these convertible notes remain outstanding and all the different terms that can vary in between. So ideally, whether you issue a convertible note or a SAFE, you're going to insist that all of the terms remain the same throughout each raise, which is very hard to do. So you want to have the same rate of interest, and it's somewhere between 2 and 8%. If you're a founder, you're going to start at 2%. If you're an investor, you're going to be looking for a higher number. You're never going to pay out cash on this, but it impacts the rate of conversion. The discount rate on conversion, I think 20% is relatively standard across decades. However, depending on the supply and the demand of capital at any given time and how hot your company is, you might be able to push that down as low as 10%, and sometimes you might have to give a discount on conversion as high as 30% or more. But trying to keep the same discount is really helpful as you raise money. Next is the cap on conversion. Oftentimes founders confuse the cap on conversion valuation with a valuation itself. And remember, a convertible note is not meant to establish a value. However, investors will often say that if you're able to raise a Series A round at a $10 million valuation, and if they were the first money in and they had to wait 2 years, that they really should benefit from the accretion in value that has occurred during that 2-year period. And they shouldn't be valued at 10 million less 20%, but rather at a cap of 5 million on value, which is what they think that their investment was worth at the time. So again, a cap on conversion is not the same as a valuation. It is what it says. It's a cap. When you have different caps on conversion, you introduce a lot of complexity and a lot of dilution to your founder and your employee team. So you want to keep that cap. You want to avoid a cap if you can, and if you do include a cap, to make it as high as possible and not confuse it with a valuation. Now that we've talked about trying to keep the terms of your various different raises of convertible notes and SAFEs as harmonious as possible, I wanted to talk about some evolution as we kick off 2020. We're seeing that companies are raising seed capital for longer and longer periods, and the time between formation and initial Series A is getting stretched out. And as a result, and because of all of the disharmonious features between the different convertible notes or SAFEs that companies have outstanding, there is all this complexity. And Y Combinator and the SAFE changed its standard form in late 2018 to accommodate this phenomenon. And they did 2 things. So the first change they introduced was measuring the valuation on a post-money, post-Series A basis rather than on a pre-money basis. This is a significant change as it limits the massive dilution that founders are suffering when these instruments stay out for longer periods. So it's really helpful for founders to make sure that you use the new SAFE form that has valuation measured on a post-money basis. The second change that they did was to remove pro rata rights to invest in future rounds from the SAFE. That used to be included as an incentive to invest in the SAFE. It's been removed. Now some investors will see that and will ask you to sign a side letter giving them those pro rata rights. But it's really nice if you can avoid that. And the new SAFE form that was introduced in late 2018 makes sure that you don't have that built in. As we wrap this video blog on seed stage financing, I wanted to say a word about the outlook. We're seeing more and more venture capital firms raise larger amounts of capital, and that those firms raise them in 3 to 4 year periods. And so we're seeing that there's a real pressure for these venture capital firms to show a rate of return on a faster basis. And because they're raising larger blocks of capital, what it takes to move the needle involves investing larger blocks of capital. All of this to say that I believe that Series A financings will occur in a company's life cycle at a later and later point. And that's going to mean that you're going to have to become more and more thoughtful and innovative about how you stretch out the amount of capital that you raise in the seed financing phase of your growth. Final note from a legal perspective, please make sure that all of your early stage financing instruments are reviewed by counsel before you sign and enter into them. I can't tell you how many times I've agreed on a form of security with the founder. They've gone and taken it out, and then they've changed terms with their investor and haven't told me. And we find out later when we're doing a Series A round that we've got some issues that we hadn't thought about. So do make sure that your instruments of financing are reviewed by counsel in advance, and that they are kept and noted in a convertible note or a safe register. Thanks again for joining us. If you have any questions, please don't hesitate to reach out to me. I'm Louis Lehot. I look forward to any comments or suggestions you have about future programming in the threads below. Thanks again.